All right, so today we're going to go over the solution to homework 10, which was the target valuation. And so on the left, I have the target model, which I have exported the data from Bloomberg and copy and pasted into the model data tab. I started with the Tesla in-class model that we have been using. And from there, we are going to finish updating the as-is valuation of Target. Now, I am doing this on Sunday, and right now their price is $95.72. It could have been as much as $10 higher this week, depending on the day that you started working on the assignment, because obviously after the tariffs were introduced, you can see the price of the stock crashed, as did many others. So you might have slightly different numbers depending on the time of your valuation. That's why we take screenshots. So in this case, I've entered this data. So I'm going to go to the assumptions tab. And first thing I need to make sure I update is the last reported year is 2025. They reported their data as of February 1st, which means they're in fiscal 26. That's what retailers do to capture the holiday season. So I need to change this to 2025. Okay. Next, I'm going to need a WAC for Target. So go to WAC. Oh, two screens, typed in the wrong one. Target, take my screenshot, and 7.5%. Again, I'll start my G around 3%. And for shares outstanding, go back to the DES. Again, take my screenshot, 455.6 million. So 455.6. And the current share price at the time valuation, top of your DES screen, 95.72. Right? And then this EEO data is going to be changed. Let me go ahead and make sure I put in the EEO data for Target. Let's go to EEO. And we're going to start putting in the consensus revenue and EBITDA forecast as of today. So for starting with 2026, 107,570. 10,045. 28 is 113,238. And then 116,069. And again, move over one column. For 2030 now is 119,492. Okay. And for the EBITDA, 8989. Oh, sorry, wrong year. Start with 2030, work backwards. 2030 EBITDA is 10,330. 2029 EBITDA is 9973. 28 EBITDA is 9363. 27 EBITDA is 8989. I got to go back over a column to get to 26. EBITDA is 8639. Okay. And then when I go over to ratios, again, for IC to sales, seems pretty consistent with historical data with the operating ratios of the future. So I don't think I need to change any of those. So ultimately, I will go to GUID. See if they give any tax rate guidance. They do. Let's take screenshot number 4. 23.5% is what they seem to be using in the out years. So I'll change it here to 23.5 in my as is. All right. So didn't really make these changes here. The only other changes to be aware of is notice this EBITDA is lingering from the previous company. So I'm just going to equal the previous year for right now. And same thing with the 2031 revenue forecast, equal the previous year. All right. So my model is at 67. I need to get to 95.72. Right. So let's look at the the numbers here. And essentially, we're going to go to the BICA, see what's going on as well. So help us kind of flesh out our as is, as well as think about our bull and our bear. So they're saying that they want to do 15 billion more revenue while expanding their margin. Um, However, cautious behavior and tariffs might blunt some of this growth, particularly in the short term. They are starting to focus on digital expansion, just like Walmart with Walmart Plus. They're starting to also do fulfillment out of their stores for same day delivery. Their traffic has been improving, yet still trails their rivals, Walmart and Costco, which is going to be important depending on the economic environment. Generally, people trade down in tougher economic times. They trade up in better economic times. I think that's benefited Target, but that might start to change. They still do a lot of branding, private labeling, partnerships with name brands to bring people into their stores, as well as their own private labels. Again, a little bit more of a premium discount retailer type of a view. Need to get better same store sales productivity. They're going to open some more stores. Looks like about 300. Their margins are better than their peers, but their growth is a little bit slower. Okay. And if we look at the industry, so again, depending on the economic outlook, that might affect what happens and who they sell to. Um, Increasing cost pressures on the business could pressure margins. So again, they need to drive higher volumes as opposed to looking for better margin. They need to try and drive some productivity out of their stores. And consumer spending will be concentrated on essentials over discretionary, which again tends to favor the Walmarts and the Costcos more so than the Targets if the economic times get tougher, right? But overall, people still shop those stores as safe havens during tough times. That was last seen in the pandemic when the discount retail sector still did strong when everybody else was doing weak as people were staying home. I still got to eat. And inflation, which had been cooling, had been benefiting them in terms of prices and margins. But again, that could be a challenge with tariffs. And freight has obviously always been a headwind in this industry. Right? Don't want to get into price wars. Competition is always an issue. Leveraging technology in the supply chain. Not expecting Target to do any big acquisitions. It says retail media network should be a strong growth engine. loyalty programs are important, target circle being one of them. AI should be able to help here in terms of efficiencies. All right, so just kind of get a sense of what's going on. So let's go back to our as is. In terms of margins for EBITDA, 8.6 is higher than it was in 2025, although it is a little lower than their peak in 2022. So in the as is, well, for now, we'll leave 8.6, growth around 3%. So I guess the question is, coming out of some tougher economic times, does the market see them a little bit better? I'm going to make an assumption that the margins do get a little bit better into perpetuity. And so I'm going to start out with 9. And so maybe this is around 3%, just margins. And then I'm going to kind of solve for a G. And so use goal seek for that. So I'm going to set sell the share price down here. Forgot to, this is the older file. Set that to 95.72 by changing the G. And let's make sure. Sure. This is actually the BMW model. I thought I was using the target model. Equals. There we go. And now we're at 95.72. So actually, right now, the market is expecting a G of -2%, right? Which can happen. So remember that G is growth into perpetuity, right? Now, if you get a big G that's negative, it can't be higher than your WACC, but if it is a bigger G that's negative, what it's basically saying is you're going out of business. Because think about this, take your revenue and then just multiply that into perpetuity. Shrink it 2% a year, 2% a year, 2% a year, 2% a year. Versus take your revenues, shrink it 15% a year, 15%, et cetera. So essentially a -2% G basically says company has peaked and the market is worried about their long-term future. Now, this is probably the subject of the tariffs, because remember, if you had done the valuation when they were trading at above $100 a share, you're probably not going to get as much of a negative G, right? And so this could just be a short-term issue related to sell everything with the tariffs and the uncertainty of the trade war, basically the Trump tariff trade war and the Trump recession that he's about to start. So again, remember the S&P is down, what, 15% recently, 10% in the last 2 days. Same with the Dow and the NASDAQ, similar amounts. So this as is gets a little bit tougher kind of as we're still in the middle of all of this, kind of like in COVID in 2021. 2020 is harder to value stocks because everything went down. And so the question is, what is kind of a more realistic long-term number? We'll address this in our bull and our bear. So again, assuming this was the as is, what it really says is at this point, people are really concerned about the long-term future of Target given this share price. Now, again, if you had done the share price when it was 105, you're probably going to get a more realistic G for the long run. But again, that's kind of where we are today. So say this is my as is. Then I need to do my bull and my bear. So I'll start out with this case. You start out with the bear, but I'm going to start out with the bull. So, what would the bull scenario be? First, that people become rational and this trade war ends in the next several months because it's basically like a circular firing squad and no one's going to win this war. We learned that in the Great Depression, and the rates that Trump has started are worse than the Smoot-Hawley tariffs that we had back then. No one thinks this is a good idea. Even Elon Musk has come out and told Trump like stop this madness. Although he'll be kicked out of the White House for saying that, but that's okay. But that's the point. Hopefully, Trump, you know, somewhat rational human being starts to realize that he has started something that he can't finish, and it's going to really wreck the economy, and that's really bad. So he starts to pull back, right? And then we return to a more normal type of environment. Well, what would that mean? Well, first of all, it means that Target is probably going to go back to growing closer to the economy. So instead of negative 2%, it would be more like a positive 2%, right? And I think that would be part of my bull scenario. I also think that, and by the way, that's $130 share price, that margins aren't going to probably get too much better because of inflationary pressures in the short term, and the growth isn't going to change all that much. But tax rates might get a little bit better if they are successful in ramming through the corporate tax cuts. So that might drop to 21.5% starting this year. And that bull scenario, which is where I'm going to end, gets me to as high as 134 a share in the next 12 months, which, if you got in this scenario, would be clearly a strong buy. Right? Do really well buying target right now on this dip if the bull scenario comes true. So I'm going to save this as my bull. I'm going to go back to my target, and we're going to talk about the bear. So what would the bear scenario for target look like? Right. Well, one of the things that could change is that tax rates don't change, gets bogged down, right? So that's one big difference between the bull and the bear. Uh, and that the other piece is that the margins are under pressure in addition to the growth under pressure. So what I'm going to do is I'm going to take these next 5 years, uh, kind of make them yellow, and saw in 2023 their margins were as low as 6%. In the short term, with the tariffs and the recessionary environment and people trading down, that might push them to 7% margins before recovering post recession to something closer to an 8% margin long term. So they still get some benefits from the supply chain, the AI initiatives that were mentioned in the BICO, but nothing nearly as beneficial uh, as they would have before the Trump tariff attack on the world. And so basically, the 7% margins are reflective of just the really tough trade war that they are in, and the fact that they have trouble importing lower cost goods. They have to pass along tariffs. They might have trouble with the workforce, given that some of the lower cost workers are being thrown out of the country. So basically, when you look at this type of a scenario, as bad as it looks, it could get worse for Target, and that would be my bear. So I think 95.72 is not necessarily the buying and the dip opportunity, and it could have further to fall. And it could fall as low as $74 a share. It could rise to 135, and there's just a lot of volatility based on this uncertainty. All right, and then what you're going to do is you're going to close out of all this, go back to my as is, and then you're going to tell me your target. Like, given all these situations, what is your opinion? And again, we might have differences of opinion. As a matter of fact, even if you look at the analysts today, not that they should be guiding your opinion per se, but just to give you a sense that when we look at the buy, sell, holds, of targets, there's 17 buys, 21 holds, and one sell, right? Even after the Trump tariff attack in the world. And so if you look at a lot of the more recent recommendations that come out, they're coming out in the hold. And what they're really saying is, if you kind of translate and read through these reports, that basically a lot of the upside that even the discount retailers were hoping to get has been put on hold because of the Trump tariffs. And they're not going to get the growth, they're going to have higher costs, and we're going to go through a tough recessionary environment where people are probably trading down to the Walmarts and Costco's, even so, and Dollar Generals more so than the Targets. And so from that perspective, I could see why people were like this scenario, which a week ago would have been the bear scenario, is probably, some trading range around this is where target's probably going to be for the near term. Now there are some people who think this is a dip and go more towards our buy type of a scenario. And one person who at BNP Paribas is in the sell range. But if you look even at the targets, most people are still around 100 because, it's not that people trade down to stay away from target, they just don't get their growth targets and don't have as much upside. So, my personal opinion is I'm probably with that group, meaning I think that Target is going to have challenges with the tariffs and some of their imported goods. I think that the higher prices are going to be a problem because they're not going to be able to pass them along to consumers, and consumers are going to get even more frugal. And unfortunately, Target sells more discretionary things than mandatory things versus some of the other discount retailers. And so they might get a little less revenue and a little less sales traffic. So translating, I don't think the growth is going to be necessarily a negative 2%, maybe negative 1%. Not a lot of growth long term damage. And ultimately, I do think that the margins are going to be a little bit lower, maybe instead of 9, down to 8.5. And essentially, I don't think the tax cuts are going to go through that Trump hopes for. And I actually think somewhere around the current price is probably a reasonable share price for Target for the next 12 months, unless something radically changes. And so therefore, I would put a hold on Target. Remember, plus or minus 10% of the current share price is a hold. All right. You got to be more than 10% above for a buy, less than 10% for a sell. Now, your buy sell hold is going to be a little different because if you had done this pre-Trump tariff attack, I call it terrorist attack. He's acting kind of like a terrorist to the economy. Then basically you might have a slightly different opinion because you might have done it before you knew what the damage that he inflicted was going to be, which was hard to ascertain. I don't think anybody predicted it was going to be as bad as it was because it really made no logical sense what he did. As a matter of fact, even the formula they used, nobody understands how you came up with that formula. So, long story short, you might have a slightly different view depending on when you turned it in last week and worked on the assignment. So, if you worked on it in class on Wednesday and turned it in on Wednesday, then you would have a $105 share price, and you might actually be more towards the buy side and be a little more optimistic on target, given everything we just read. But obviously, the shifting sands of the last 3 days has probably changed the market's view. Now, this is shock, and again, remain to be seen whether or not people come to their senses. But if they don't, and they just push through this, then we could be in for some darker times, and Target is not going to go unscathed in those darker times. I think they'll weather it better than some companies, but regardless, that's why I'm putting them on a hold given the most recent information. All right, so that is the target valuation. Um, what we're going to be doing this week is today you're watching the video. Uh, Wednesday, we will have a live class. I'll let you know what sections are live. And we're going to make one final adjustment to the model on Wednesday. And the adjustment's going to be around how to make sure we come up with a realistic operating income. What we've done so far is we're kind of riffing on what we think it could be based on, an amalgamation of reading some of the data from an EIC. I'm going to show you that there's actually data in the marketplace that will help us get a much more reasonable interpretation of what that perpetuity operating income can be from the multiples of the company. So we're going to add that to our model on Wednesday. I want to do it today because I want to confuse you with this assignment. But then from there, you'll do one more valuation for next Monday with that kind of new nuance. And then a week from Wednesday will be your group projects. And this group project set will be different than the last group project set in that on this Wednesday, I'm going to give your sections an industry. And each of the 6 teams in that section is going to choose a company in that industry to value meaning, and you can't value the same company. So just for example, if I said discount retail for the 11 a.m. section, then somebody could do Target, somebody could do Costco, somebody could do Walmart, somebody could do Dollar Tree, somebody could do uh, Dollar General, but two people can't do Dollar General, or two people can't do Walmart, right? And it'll become first come, first serve. So what I'll be doing is I'll be asking you to send me an email with your first and second choices, because if the first choice is gone, then you need an alternative. And that basically, for the live classes, they'll pick them live. For the ones that aren't live, you'll send me the emails, and you will pick the industry and the company that you'll work on. You'll then have a week to work on it as a team. Okay, so you'll have two assignments the week of the 13th. On the 14th, which is Monday, you have an individual assignment with the modified model that will finish on Wednesday. And on the 16th, you'll actually be doing your presentations on one of the companies that you have picked in an industry. And all four sections will have four different industries. And I haven't figured out which the industries are. I'm kind of waiting to see how things play out on Monday and Tuesday to decide which industries to give you. But regardless, I'll choose an industry, you'll choose a company in that industry, and that's who you will do your evaluation on. So that is what is up and coming. And by the way, the following Friday, your peer reviews will be due. So don't forget to fill out those peer reviews. All right. So again, if you have any questions, feel free to reach out to me or the TAs. We are not giving you these models. We want you to build them yourselves. And if I give you the model, then you can kind of get by without building it yourself. So again, if you've had trouble with any of this, please take advantage of the office hours of the TAs to help you get them fixed, because each of you should have an individual working model by now. Okay. So appreciate your time today. Good luck, and look forward to seeing everybody more in a live session on Wednesday.